We swim in a sea of stories. The market, in particular, is a canvas painted with narratives. These are not mere anecdotes. They are powerful forces, shaping perceptions, fueling emotions, and ultimately dictating investment decisions. But when do these compelling tales cross the line from insightful commentary to outright manipulation? When does a market narrative, designed to explain or predict, begin to actively steer your portfolio down a path that serves others' interests more than your own? Today, we begin a journey to uncover the very architecture of these financial stories. We will delve into the 8 fundamental truths about market narratives that often operate just beneath the surface, unseen by the majority, yet profoundly influencing their financial destinies. This is not about predicting market movements. It is about understanding the psychological and cognitive mechanisms that make us susceptible to certain tales, regardless of their underlying factual basis. Our mission here is simple yet profound: to equip you with the critical lens necessary to discern genuine signals from the pervasive, manipulative noise. We aim to foster a skepticism rooted not in cynicism, but in rigorous analysis and a deep understanding of how our own minds can be swayed. Think of the wisdom Benjamin Graham imparted in The Intelligent Investor. He famously stated, "The investor's chief problem is likely to be his own temperament." Market narratives are masters at exploiting this very temperament. They prey on our hopes, our fears, our desire for belonging, and our innate tendency to seek simple explanations in a complex world. They offer comfort in certainty, even when that certainty is an illusion. We are here to dissect these narratives, to peel back their layers, and to reveal the often hidden mechanisms that make them so persuasive. We will explore how seemingly objective market trends are often constructed, amplified, and weaponized. By understanding these 8 truths, you will begin to see the market not just as a collection of numbers, but as a complex interplay of data, psychology, and storytelling. Are you ready to look beyond the headlines and understand the deeper forces shaping your investment decisions? Truth number 1. The follow the leader fallacy. There's a primal comfort in seeing others move in a certain direction, isn't there? Narratives like "everyone is buying this stock" or "this sector is the future" tap into the deep-seated human need for belonging and security. It feels safer to be in the crowd, to believe that what is popular must be correct. This psychological allure of consensus creates a potent, yet often illusory, sense of security. Consider the frenzy of the dot-com bubble. Suddenly, the narrative was that the internet would revolutionize everything, and any company with a double quotes .com in its name was destined for greatness. Fundamentals were cast aside, valuations soared to astronomical heights, driven by a collective belief in a future that, for many, never materialized. More recently, we've seen similar narratives around meme stocks, where shared online sentiment, not intrinsic value, became the primary driver. The outcome, for many who followed the herd without question, it was a painful lesson. This is the danger of groupthink. The narrative becomes so dominant, so pervasive, that dissenting voices or critical analysis are silenced, dismissed, or simply drowned out. The crowd, in its collective enthusiasm, can lead not to riches, but to ruin. The myth that the crowd is always right is precisely that, a myth, often perpetuated by those who benefit from its momentum. So, how do we navigate this? Develop your personal investment constitution. This isn't about being a contrarian for its own sake, but about anchoring your decisions to your own rigorous research and fundamental analysis, not to the shifting sands of market sentiment. It's about having a clear, unwavering set of principles that guide you, regardless of the prevailing narrative. Imagine a ship captain entrusted with the lives of their passengers, choosing to steer by the cheers of the crowd on deck rather than by the charts and compass that accurately represent the sea and sky. The cheering crowd is the seductive market narrative. The charts and compass are your data, your analysis, your independent thought. Which will you trust? Truth number 2. The fear of missing out, or FOMO trap. Have you ever felt that prickle of anxiety when a narrative screams, "This opportunity will never come again," or "Buy now before it's too late"? These are urgency narratives, expertly crafted to bypass your rational mind and trigger an immediate, often impulsive, reaction. They play on our deepest fears of regret and exclusion. From a neurological standpoint, FOMO is a powerful force. The perceived scarcity, the fleeting nature of the opportunity, can trigger a dopamine hit. This chemical surge in our brains creates a sense of excitement, a feeling of being on the cusp of something extraordinary. It's intoxicating, and it can powerfully override our capacity for rational thought and patient analysis. We start to believe the narrative because the feeling of potential gain is so immediate and intense. But here lies the hidden risk. These urgency narratives often serve to mask assets that are already overvalued or trends that are unsustainable. They encourage buying at the peak, just as the momentum is about to falter. The story is one of imminent, massive gains, but the underlying reality is often one of inflated prices and impending corrections. The narrative is a siren song, luring you towards the rocks. Your practical defense against this potent emotional trap is to implement implement a waiting period for significant investment decisions. Force yourself to pause, step away from the immediate pressure. This cool-down period allows your analytical mind to re-engage, to question the narrative, and to assess the actual data, not just the emotional pull. Think of the gambler at a slot machine. The flashing lights, the jingles, the almost asterisk wins. They all create a powerful illusion of imminent fortune. They ignore the statistically inevitable losses in favor of the fleeting thrill of a potential jackpot. FOMO narratives are the casino of the financial world, and without a disciplined waiting period, you risk becoming just another player chasing an illusion, unaware of the true odds. Truth number 3. The shiny object syndrome narrative. In the relentless pursuit of wealth, we are constantly bombarded with tales of the next big thing, the disruptive innovation that will change the world. These narratives are incredibly alluring, promising a shortcut to riches by identifying the future before anyone else. But often, this fascination with novelty distracts us from the enduring principles of sound investing. Think back to the hype cycles of past technological marvels. Remember the excitement around 3D printing or the early promises of artificial intelligence. While these fields have indeed evolved, the initial narratives often painted a picture of immediate, universal disruption that didn't quite materialize as dramatically as predicted. Meanwhile, established companies, perhaps less flashy but with robust business models, consistent cash flow, and durable competitive moats, continued to generate value steadily. The shiny object narrative can blind us to the quiet strength of substance. We often fall prey to story stocks over value stocks. A compelling narrative about a company's vision or its revolutionary product can be far more captivating than a dry financial statement. This makes it easy to overlook fundamental weaknesses, unproven business models, or unsustainable cost structures. The story is captivating, but the financials tell a different, often sobering, tale. To defend against this, develop a simple checklist for evaluating new opportunities. Prioritize fundamental strength. Ask, does this company have a sustainable competitive advantage, a true moat? Is its cash flow reliable and growing? Does its business model make sense beyond the initial excitement? Novelty itself is not a strategy. Substance is. It's akin to a prospector deep in the mountains, abandoning a rich vein of gold because they spot a glint of pyrite, fool's gold, nearby. The pyrite is shinier, more intriguing, perhaps sparking a more exciting story, but it will never yield the true wealth that the overlooked gold offers. The narrative of the shiny object can lead us to mistake fool's gold for genuine treasure. Truth number 4. The simplifier's deception. Our minds crave order and simplicity. In the face of overwhelming complexity, we naturally gravitate towards explanations that offer easy answers. Market narratives often exploit this cognitive bias by reducing intricate financial realities into digestible, often misleading soundbites. Think of the pervasive narrative, especially during bull markets, that simply states stocks only go up. This is the cognitive ease paradox at play. Our brains find it far more comfortable and less demanding to accept a simple, linear explanation than to grapple with the nuanced, multifaceted nature of financial markets. This preference makes us incredibly susceptible to narratives that ignore crucial details, downplay risk, and present an overly rosy picture. The allure of simplicity becomes a powerful tool for manipulation. The hidden cost of such oversimplification is profound. By accepting these neat, tidy stories, we miss the vital details about inherent risks, the true state of valuation, and the broader economic environment that are absolutely essential for sound investment decision-making. The narrative of stocks only go up fails to account for recessions, interest rate hikes, geopolitical instability, or the cyclical nature of markets. A powerful defense against this deception is to practice devil's advocate thinking. For every narrative you encounter, actively seek out the reasons why it might be wrong. Challenge the simplicity. Ask yourself, what complexities are being ignored? What are the potential downsides? What if the opposite were true? It's like a doctor who prescribes a single, generic pill for every illness, from a headache to a serious infection. This simplistic approach ignores the specific diagnosis, the patient's history, and the unique nature of their ailment. The simplified narrative is the cure-all that fails to address the actual, complex root cause, potentially leading to serious consequences. True understanding requires embracing complexity, not shying away from it. Truth number 5. The authority bias narrative. We are often taught to respect authority, and in the financial world, this translates into a deep-seated tendency to defer to perceived experts. Narratives that come from famous investors, renowned analysts, or influential media personalities carry immense weight. We hear their pronouncements, their predictions, their market interpretations, and often we accept them without critical evaluation. This deference is rooted in psychology. The authority bias tells us that we are more likely to believe and follow the advice of someone we perceive as having greater knowledge, status, or power. It's a mental shortcut, a way to offload the burden of complex decision-making. But this shortcut can lead us directly into the path of manipulation. An expert's story, no matter how eloquently told, might be outdated, distorted, influenced by their own biases, or simply not applicable to your unique financial situation. The fallacy of the market guru is a recurring theme. We see individuals rise to prominence with seemingly impeccable track records, their pronouncements treated as gospel. Yet, a closer examination often reveals that their success was either a product of fortunate timing, a temporary market condition, or a narrative they skillfully crafted. Separating their compelling stories from verifiable, consistent data is crucial. Your empowerment strategy lies in developing a framework for evaluating advice. Instead of asking, "Who said this?" ask, "What is the logic behind this statement? What data supports it? Does it align with my own well-researched investment philosophy?" The reputation of the source should be secondary to the substance and validity of the advice itself. Consider the analogy of following a map drawn by a renowned explorer from centuries ago. That explorer may have been brilliant in their time, but the world changes. Continents shift, new routes are discovered, and dangers emerge that were unknown then. Their outdated map, however authoritative it once was, could now lead you into uncharted and potentially dangerous territory. The expert's narrative, if not critically examined against current realities, can become your own outdated map, guiding you astray. We've journeyed through the landscape of market narratives, uncovering how they can subtly, yet powerfully, manipulate our investment decisions. We've begun to deconstruct 5 of these pervasive truths: the seductive pull of the follow the leader fallacy, the urgent siren song of the FOMO trap, the distracting allure of shiny object syndrome, the deceptive comfort of the simplifier's deception, and the unquestioning deference to the authority bias. These are not isolated incidents. They are recurring patterns designed to sway us, often away from sound financial principles and towards costly missteps. But understanding these mechanisms is only the first step. The true antidote lies in cultivating a data-driven mindset and fostering a healthy skepticism towards every compelling market story that crosses your path. It's about recognizing that while narratives can be illuminating, they can also be blinding. Your most potent investment tool is not a sophisticated algorithm or insider information. It is your ability to critically dissect these narratives, to question their origins, their motives, and their underlying truth. This journey requires a commitment to critical thinking. It means looking beyond the surface, digging into the fundamentals, and trusting your own research and analysis over the clamor of popular opinion or the pronouncements of self-proclaimed experts. It is about building an internal compass that guides you through the often turbulent seas of financial information. As Warren Buffett wisely advised, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Similarly, it is far better to invest the time and effort to understand a true financial principle, even if the learning process feels challenging, than to chase a flawed, manipulative narrative at a high cost to your capital. The cost of truly understanding is always less than the cost of being misled. The market will always speak in stories. Our task is not to silence them, but to learn to listen discerningly, to discern the whispers of truth from the shouts of manipulation, to build an investment strategy anchored not in fleeting tales, but in enduring principles and verifiable data. So, as you move forward, ask yourself, what narrative am I currently following, and what is its true cost?